Good morning. Thank you all for coming here today. I'd like to greet you all to the Global Interdependence Center's Central Banking Series here in Tokyo. Our sponsor, Asset Management One, we'd like to thank them, and in particular, Kozo and his team for helping put this together. And my executive director, Jill Fernito, who has helped put this together from the U.S. side. We are a nonprofit based in Philadelphia, Pennsylvania. President Harker from the Federal Reserve Bank of Philadelphia is actually our landlord. Our offices are headquartered at the bank. It's a long-standing relationship that we're very pleased with. Our goal is to hold the event, that is, to have the discussion on topics which are of interest to the financial services and finance professionals and political people in general who are interested in global interdependence. We started 41 years ago in 1976 during the American Bicentennial, when our founder, Frederick Heldring, said that it's wonderful to celebrate American independence, but what we should be celebrating is global interdependence, which in 1976 was a fairly unique idea. And it's flourished since then. We now hold somewhere between 15 and 20 conferences a year, all across the United States and all around the world. This is our second visit to Tokyo. We're pleased to be back. If you are interested in our programs, I ask you to look at the back page of the program where some of them are highlighted. Our next event is in Philadelphia on December 8th, and it will be our annual fundraiser. Then we move to San Diego on January 12th, where we will be giving our Founders Award to Eric Rosengren, the President of the Federal Reserve Bank of Boston. Then we move to our international programs. We have an event in Zurich on Monday, February 5th, and then on the Friday following, we will be at the Bundesbank in Germany, where we have the presidents of the Banque de France, the Bundesbank, the chief economists of the ECB, Axel Weber from UBS, and Catherine Mann, who's just left as chief economist of the OECD. It should be quite an event. Then we move to Sarasota, Florida in February, before returning to Argentina for our fourth trip to Buenos Aires on March 7th through the 9th. We have events through the remainder of the year. The next big one for those interested in international is on March 14th and 15th. We'll be at the Banque de France. And then the following Thursday, Friday in Madrid, in conjunction with the Foundation Del Pino and BBVA, the largest financial institution in Spain. And then finally, our 10th annual Rocky Mountain Economic Summit will be held in Victor, Idaho, which is just over the mountains from Jackson Hole, Wyoming. That event is on July 12th and 13th, and I greet Justin Hyde and our delegation from Victor who have come to Tokyo for this event. Thank you all very much for coming. I'd like to invite our first panel up, and Akinari Horii as the moderator. Thank you.
アセットマネジメント案の小出でございます。パネリストの方にお座りいただくほんの1分ぐらいの間にパネリストをお務めいただくことになった堀井さんについて簡単にご紹介をしておきます。堀井さん、74年のご入校です。74年に東京大学の経済学部をご卒業になって日銀にお入りになりまして、大蔵省にもご出向、BIS にも行かれて、私が最初にお会いした時には景気分析の課長でいらっしゃいましたけれども、 企画調査、それから後半は国際部門のご担当が長くて、2006年まさに金融危機がこれからひどくなるという時に国際問題ご担当の理事にご就任をされて、まさに一番金融が世界で揺れた時期にいわゆる中央銀行マフィアの一人として、活躍をされた方でございます。それでは堀先生、堀さんよろしくお願いいたします。
Well, I didn't know that I'm supposed to speak Japanese as Koide-san spoke, but perhaps English is a language that we can communicate with. So let me continue to speak in English rather than Japanese, if you don't mind. All right? Okay. I'm Akinari Horii. I'm not David Kotok, as indicated in earlier versions of the program. So I'm his pinch hit, actually. So let's begin this most interesting panel, and we have a list of distinguished panelists this morning. Let me introduce from your right Mr. Harker, President, CEO of the Federal Reserve Bank of Philadelphia. By the way, I'm from Wharton School. Philadelphia is very familiar to me. And to his left, Frau Gudrun Moede, if I pronounce correctly. She's chief rep of the Deutsche Bundesbank in Tokyo. And further left, Mr. Nakata, Director General of the International Department of the BOJ. I hope you have a program at hand and their bios are available. So for the sake of time saving, let me first ask each panelist make their initial remarks for 20 minutes each, and beginning with President Harker, please. Oh, whichever, yes.
Well, good morning. It's truly a pleasure to be here, and I'd like to thank our host for their exceptional hospitality in such exquisite surroundings. Now, in cases like this, you feel compelled to reciprocate by way of cultural exchange with some emblem of your country. But I realize that much of what we hold as quintessentially American, from blue jeans to baseball, has been so embraced, and I dare say, so improved in some cases, that they're also quintessentially Japanese. I find, therefore, that the remaining unique tradition that I can share today is this: the standard Fed disclaimer, that the views I express today are mine alone and do not necessarily reflect anyone else in the Federal Reserve System. I know it's not much of a reciprocal gift, but that's what I've got. So, with that out of the way, I'll begin by noting the subject of today's panel: how to cope with unconventional policy. Now, I suppose it stands out to me because while unconventional policy certainly needs to be managed and requires an adjustment by both policymakers and markets, it is overall a coping mechanism in and of itself. Each of us turn to these tools to address our own situations during and after the financial crisis. Unconventional policy was the salve to the crisis's wounds. Each of us on this panel, and indeed in this room, brings a different perspective on how these policies played out. But we're all more or less on the same path. We're just at different points on a journey that ultimately leads to normalization. In the United States, we're a bit farther along than our counterparts, and as such can be looked at as something of a test case, though the cynic might compare us instead to the canary in the proverbial coal mine. In either case, our steps so far can prove illuminating, and some of our research and discoveries may prove informative as well. The caveat, of course, is that there are a few differences in the case of the United States. Unlike many in this room, the U.S. did not enter into a regime of negative rates. Instead, we lowered the Fed funds rate to essentially zero, then engaged in 3 rounds of quantitative easing when rates failed to adequately spur recovery. We are not alone in that experience, although we are farther ahead in terms of normalization. And the last qualification. In the grand tradition of Americans retaining the imperial measurement system and the Fahrenheit system, monetary policy implementation in the United States is just different enough than others to make an exact translation very difficult. That said, and with those caveats, I believe our experience can still be informative. Now, as a quick reminder, I'll offer a brief history of U.S. monetary policy during and after the crash. When lowering rates to near zero failed to jumpstart the economy, we turned, as most of us in this room did, to unconventional policies, which were primarily driven by large-scale asset purchases, or LSAPs, a phrase policy wonks concede we have lost the battle on. So I'll simply refer to the program by its better-known moniker of quantitative easing, or QE. QE involved buying more and different assets than our usual practice of holding mostly short-term treasuries. We purchased longer-term treasuries and bought mortgage-backed securities. The balance sheet swelled to approximately $4.5 trillion, a significant increase from the roughly $900 billion balance before the onset of the crisis. Since late 2014, when we ended purchases, we have been reinvesting the proceeds as they've reached maturity, keeping the balance sheet constant until last month. A modest rate hike in December of 2015 signaled the first baby steps toward normalization. We've since raised them 3 more times by 25 basis points each time, and I still have another 25 basis point rate increase penciled in for this year, although perhaps I should say lightly penciled in. That, of course, is not the only mechanism by which normalization must occur. In our September FOMC meeting, we voted to start the process of unwinding the balance sheet commencing last month. The size of the balance sheet is larger than we've ever seen, and the MBS, in particular, renders its makeup different than before the crisis. Current assets are made up primarily of those treasuries and MBS, while the liability side overwhelmingly consists of paper currency and bank reserves, those balances, and to a much lesser extent, overnight reverse repurchase, or reverse repo, that facility as well. It's true that we haven't faced exactly this type of normalization before. No one has. But it's also true that it's unlikely to be a remotely interesting policy event, except as some chapter in some future generation's economic textbook. The plan is, and I believe this will be the case, this normalization of the balance sheet will be slow, deliberate, boring, and essentially on autopilot. To look at what we've done and are planning to do, and to consider what lessons that could hold for other central banks, we should go back for a moment to first principles. Why, for instance, is a legitimate question. It is possible to maintain an exorbitantly large balance sheet and let the growth of the economy eventually render it proportional. From my perspective, removing accommodation is the right next step for a few reasons. Monetary policy in the United States has been very accommodative for close to a decade. The economy now is more or less at full strength. There's very little slack left in the labor market, and growth has kept pace with our projections. Now, inflation is still below the Fed's target rate, and it is the one area that not only continues to elicit caution, but it even constitutes a conundrum. Now, I won't get into too much detail, but some work by my staff, for example, suggests that the Phillips curve has not been a good predictor of inflation over the past several decades, not just over the past few years. I do think, however, we have to be cautious about how we're measuring inflation. At the same time, I do not advocate throwing out all conventional economic positions with the bathwater. With a labor market this tight, inflation is likely to reassert itself at some point. All of which is to say that we are near the point of full health, and it makes sense to return policy to a normal stance. This is also about keeping our powder dry. In the event of another shock to the system, I want our tools to be at their most effective, and in my view, that means reducing our balance sheet. Additionally, as productivity has dropped, it's taken the neutral funds rate with it, making the zero lower bound closer and resulting in less room for maneuver with the funds rate, which will continue to be our primary monetary policy tool. In the case of rates returning to zero, then, if something were to happen, if another crisis were to occur, further asset purchases may prove less effective or perhaps simply more difficult and costly to execute with a large balance sheet still in place. You know, the famous line is that the Fed takes away the punch bowl just as the party is getting good. I don't think we're taking away the bowl. I think we're making sure there's enough punch for the future. In making the decision to start bringing the balance sheet back into alignment, three aspects were crucial. How to do it was obviously top of mind, but also how to ensure a slow, steady pace that could essentially be left to churn on its own. We also knew from past experience that communicating our intentions was going to be a key factor in this effort. The means of unwinding the balance sheet were straightforward. We could either stop reinvesting the securities as they come to maturity or sell them in the open market. We opted for the former, with gradually increasing caps on the amounts that are not reinvested. This ensures the crucial aspects of gradual, predictable, and boring that we're aiming for. This is not to say that we will ignore the process as it unfolds. We will keep a watchful eye and revisit it in meetings. If economic or other events necessitate intervention, we will make that call. But we fundamentally want this to slowly and mechanically happen in the background. Now, I've said before that this will be the policy equivalent as exciting as watching paint dry. But I should specify that the paint in this case is oil-based. The process is going to take some time. We have not yet established what the new normal will look like. The balance sheet will definitely be bigger than it was before the crisis because the economy is bigger. But its eventual size will depend on how overnight and other short-term rates behave as the unwinding progresses. Also vital to our plans is the sense of predictability. I'm not sure there's a single Fed employee from president to examiner who didn't take the lessons of the 2013 taper tantrum to heart. Regarding unwinding then, we made every effort to communicate early and often, and as clearly as possible. That is a feat for an organization renowned for its policy speak, to ensure the message was clear. The market response to the announcement was somewhere between a yawn and a shrug. So I really do have to commend the entire Fed system for clarity and consistency of message. It's one of the key successes I'd point to in managing normalization after such an extraordinary time. Now, there are other lessons to be gleaned, not just from the progress on the balance sheet, but from the moment of liftoff. One of the most important is that in the normalization process, it is possible to manage the balance sheet and rates separately, albeit with limits. When we ended QE in late 2014, serious questions were posed about the feasibility of raising rates given the size of the balance sheet. Traditionally, the New York Fed's market units that implement the policy, which we will refer to simply as the desk, implemented rate increases by making reserves scarce in the Fed funds market. But more than $2 trillion of reserves rendered them anything but scarce. The only way the desk could remove $2 trillion of reserves overnight would be by effectively holding the largest fire sale in economic history. The current situation necessitated a great deal of effort to gain a deep understanding of uncharted waters. Ultimately, a combination of expertise and analysis engineered a successful liftoff in December of 2015. Rates have been under control since and remain well connected to other money markets. As the FOMC decides to increase the target range for the Fed funds rate, it increases both the interest banks earn on reserves and the rate an extended list of counterparties can earn via the reverse repo facility. Here, I'll return to the note I made earlier that the United States differs in a few areas. In the classic model of a corridor system in monetary policy, the interest on reserves provides a floor for the obvious reason that no bank wants to lend at a lower rate than it would earn by simply keeping its balances. In the U.S., however, not all institutions qualify to earn interest on reserves. With reserve markets satiated, it is therefore the reverse repos available to a wider range of additional institutions that provide a firm floor on market rates, and the interest on reserves provides a cap. These two rates, interest on reserves and reverse repos, currently form the boundaries of the Fed funds target. Research by my staff correctly predicted that most Fed fund trades would occur at rates safely in the middle of the target range, even if actual use of the reverse repos is quite low. By offering an alternative to trades in the market, the reverse repo facility improves the bargaining position of lenders and drives rates, even if lenders rarely have to resort to the facility, a spooky action at a distance. That also helps to keep the Fed funds rate connected to other money market rates. So as our balance sheet declines, so does the supply of reserves. Eventually, reserves could become scarce again, which would theoretically make it possible to return to a classic corridor system in which interest on reserves operates as a firm floor on market rates. Now, exactly what level of reserves would enable that is a topic of ongoing research and debate. That level could be substantially larger than the last time we conducted policy in a reserve-scarce environment, owing to how much has changed since 2008. I will therefore continue to monitor this issue as the balance sheet shrinks. The United States is, by and large, farther down the road to normalization than other countries that turned to unconventional policies. And as such, we can pass along the lessons of our experience so far. These are clearly not direct correlations, but there are echoes, and we will all operate on the fundamental monetary policy oath of first, do no harm. The knowledge that rates and the balance sheet can be decoupled has been invaluable, as has the work to prepare the markets for what's to come. This is a new path for all of us. What we're trying to do has never been done before, at least not on this scale. And while it might be, to borrow a phrase, the final frontier of monetary policy, I do believe we'll pull off the ultimate feat and make a couple $1 trillion utterly uninteresting. Thank you.
Thank you, President Harker. He has covered almost all important aspects of the Fed's normalization process, and also a brief history of what happened to the Fed during 3 stages of QE time. But rather than starting Q&As, let me call on Gudrun. Thank you. Thank you, Moede, for her initial expose. Bitte schön.
Thank you. Well, ladies and gentlemen, good morning. My name is pronounced perfectly by our moderator, but I know it's too difficult for most of you, so usually I call myself Monika, Moede, which is my first name, and, well, I'm indeed the head of the Bundesbank representative office in Tokyo, and I guess in this panel I'm covering the European part, which is okay. The Bundesbank is the biggest central bank in the European system of central banks, and we are the biggest shareholder of the ECB, so I'm quite happy to cover the European view. But first of all, let me also thank Mr. Koide for this kind invitation to speak here. And yeah, I hope you will all move also to Frankfurt next year and follow up on the central banking seminar next year. Hope to see you there. Okay, I've brought a few slides with me that should guide us through this topic. And before we start discussing the monetary policy issues, let's have a look at the general situation in the euro area. And as a central banker, sure, my first slide is then on the inflation. Just to remind you, the ECB has defined the price stability as a year-on-year increase in the harmonized index of consumer prices for the euro area for below 2%, which is the red line in this chart. In the pursuit of the price stability, the ECB aims at maintaining inflation rates below, but close to 2% over the medium term. So this, if you look in detail in this wording, it gives some leeway. And at the moment, well, you can see, well, it's not as bad as it had been, but we are still a bit away from the target. The euro area at the moment has an inflation rate of 1.5%. And expecting the same for the whole of the year. For 2018, yes, expecting 1.2%, or the market's a bit more optimistic. The professional forecast says 1.4%. But nevertheless, that seems to be the kind of bottoming out probably in February. So when you're in Frankfurt, probably the situation might look worse, but we're expecting it to improve after that. So leading to a higher inflation after that in 2019. But speaking of the euro area, you also have to keep in mind that there are differences between the countries. So with Germany I'm coming from, I'll say yes, we have 1.8% of inflation. So yeah, you could say we are already there. But other countries are a bit further away to come to the average. So like France with 1.1%, or Greece even below that. But it's improving. just to have a look on the other side of this coin is from the inflation rates is rates. I just have put in here the comparison with the other regions, and at the top here you see the US with fund rates, and followed now by Britain. There's a Bank of England having raised the rates just recently in beginning of November, and then it's Europe and Japan following that. If you just look at the rates, it looks a bit kind of probably not the picture in the mind we have. So if the feeling in Europe is more kind of closer to the upward trend, so feeling to be closer to the US than kind of the wait and see situation we still see in Japan. Just the mindset is more on the upward trend. The other economic factors we look at, it looks good. I mean, there's one good news after the other in Europe. So we have a real growth of the GDP on second quarter was 0.7%. It's making an annual growth of 2.3, expecting 2.5 after having a look at the third quarter's figures. It's the highest rate since 2011. And so on. The same is with good news from the employment side. The unemployment rate in the euro area is now well below 10%, which, being in Japan, it sounds outrageous high, but you have to remember where we came from, and we still have countries like Spain who have two digits with 17.1. But it's okay, it's well below 20% now, and the economy is improving. The good news, especially from the Spanish, Portuguese side. And Germany, with an unemployment rate below 6%, is actually now already struggling with getting the right labor workforce for the jobs we need to be done. So in general, the economic outlook is really nice in Europe, and this is also reflected in annual growth of the loans for non-financial corporates and also on the households, so could be happy. It's just the inflation, and unfortunately that's the thing the central bank is in charge of, and well, we have to see how it's going on. I've brought some of the recent news with me, so that was the kind of headlines just before the last meeting and the last ECB monetary policy decision. It's mainly kind of asking for, or a news agency expecting the first steps for ending this highly expansive monetary policy. And the main thing that was to be discussed in the papers was the pace. And like the kind of market was slightly afraid of what the ECB was going to do. I mean, it was clear there would be a step on what's going to happen. On the other hand, it was the same for the ECB, or the European system of central banks. Taking the first step, probably was the same in the US, it's always difficult. So on the other side was also making sure that it's well communicated, official communication, kind of bilateral communication in small groups with market participants, just to make sure that we are not be surprised. So, but before we'll discuss probably the latest steps, talking about unconventional measures, or that's the topic of today. But before we talk about unconventional, we probably should remind ourselves what happened to the standard monetary policy measures at all. What was the normal thing? The normal was, and what we maybe come back to at some stage, the conventional monetary measures is that the ECB signals its monetary policy strategy, the tightening or the easing, by managing the key interest rates on the short end. So interest rates of deposits and margin lending facilities, and the interest rates of the main refinancing operations. Furthermore, we're using the standing facility, the broad interest rate corridor, interest-bearing minimum reserves, and so on and so on. Well, we changed it all. Yep, changed it all, coming up with unconventional measures in, let's say, 4 areas. With low and negative interest rates. So the interest rates of the main refinancing operation is at 0, and negative interest rates for the deposit facilities. We introduced forward guidance. I'll come back to this in more detail a bit later on. And these, what we always call liquidity measures, relaxation of the collateral framework. So we're accepting more collateral than we did before. We have fixed rate and full allotments of the tenders. Furthermore, reducing minimum reserve rate for the deposits. So all the kind of traditional instruments were relaxed, introducing also longer-term refinancing operations. This is followed by the then powerful purchase programs. With the security markets program, the SMP was back in 2010. I don't know whether any of you remember this. And then the announcement of the outright monetary transaction, the OMT, it was already in 2012, but it's not used. I mean, it's not active at the moment. The last on this slide is the asset purchase program, with different programs like the ABS-PP, the covered bonds purchase program, the corporate sector purchase program, and public sector program. They all kind of just listed here, but you may know the most important is the public sector purchase program, with a volume of 1,796.5 billion euro at the moment. So far, so good. The next question is, what are the possible strategies to exit non-standard monetary policy measures? And it's not something that we decide once and then it's just going to happen. We have closely following what's going to happen in the US and how it's done there. Sure, we take in what might be a possible strategy, but there are little bits and pieces you can fine-tune. And this is what I want to highlight, that there are options, probably not always just do one thing, but also minor options to handle bits and pieces of these topics we are talking about. So the low and negative interest rates, sure, there we can change the interest rates. The timing and the pace of adjusting the interest rates is surely a very strong measure that could be taken. The changes in the range of the basis points between the key interest rates is always nicely to look at. That's all possible, but not yet. The decision on the 26th of October, which is the interest rates on the main refinancing operations are capped with 0% marginal lending, and the deposit facility also remain unchanged. And it has been a very specific guidance. There's a continuous forward guidance that will be kept on the key interest rates. So it will stay, and we'll have a look at the wording a bit later on, just to give you some information on the details. The purchase programs, which are usually in the thing of, the markets are focusing on at the moment. There's always the question of a strict versus a smooth termination, the prolongation of the assets programs with lower volumes for a limited time. This is actually what was done. I'll just forget. But there's also the question whether you want to stop or reduce the volume for parts of the assets purchase programs. So we have several, as I listed them, purchase programs. You could also decide to kind of get rid of one or the other purchase program and focus just on the biggest. Anyway, the decision was a reduced volume from January 2018 on until September 2018. It will be interesting to see how it's going, how the decision process will be handled next year, because September is just after the summer break. And the kind of latest staff forecasts actually will be the June ones, so you can't take the decision too late, so maybe the decision will be expected then already before the summer break. Well, we'll see what kind of figures will be available then, especially the background that we're expecting inflation to bottom out around probably February. If it's late, then it's March. You see, there's always a lag with getting the information and having then information available that's feeding into the story of what you want to do. Yes, it's decided that the reinvestment of the principal payments from the maturing securities will be done, and it will be done in the same jurisdiction. Well, that's details about Europe, who is investing how much. And actually, this is now supported by additional information on the monthly redemption amounts for the APPs over a kind of 12 months horizon rolling over. So it's clear and more transparent for the market what's going on. Yes. Concerning liquidity measures, there's a possibility to return to the competitive tender allotments, raising the minimum reserves, etc., all those things we had in the good old times. It will stay as it is at the moment, the continuation of the fixed rate tenders with full allotments as long as necessary, and at least until the end of the reserve maintenance period in 2019. So this gives a lot of confidence in the market to say, okay, we know at least where the basis is of all the information. Forward guidance. I'm not going to read all these comments, but just pick out the 2010 probably, or well, probably the first is a shorter one. Trichet always said, as you know, we never pre-commit ourselves unconditionally. You can find a lot of statements from him saying never to pre-commit in advance and so on. And it was not just him. In 2011, Draghi said, I mean, the answer to the question, as you know by now, after 8 years of Jean-Claude Trichet, is that we never pre-commit. Well, never say never. It has changed. So, and that's actually quite often the most important wording that needs to be looked at is forward guidance that was introduced then in 2013. And where we say, for example, will remain accommodative for as long as necessary, or wordings like for an extended period of time. So this is still the wording we'll find. Well, in the end, in 2017, last wording is well past the horizon of the net asset purchases. And this actually gives a kind of how the future is going to be. We'll stay with the interest rate as you can expect till the net purchases end. So, a bit more on forward guiding. Yes, there's still no final commitment to end the APP. We still see there's still the need for a sustained adjustment in the path of the inflation, and even saying that the ECB stands ready to increase APP in terms of size and or duration. So it's still open what's going to happen. We still need to wait a bit. But nevertheless, the reasons given in the introductory statement to the press conference, there had been a few words that have changed from before. They used the kind of things like the recalibration of our asset purchases, and other things like, therefore, an ample degree of monetary stimulus remains, which usually before that always was read like, therefore, an substantial degree of monetary stimulus remains necessary. Well, that's the fine-tuning on the wording is done beforehand. There are several options, and it's not just speaking as the word comes into the mouth. It's definitely fine-tuning, and there are kind of small signs that there might be the chance of a bigger change to come. Okay, the press or the markets were not surprised. Comment was indeed baby step, but not big bang. Okay, we don't want to have hectic movements in the markets anyway. And I have to comment, my governor, Weidmann, says that the ECB should have set a clear end date for bond buying. Sure, you always know the Bundesbank is on the hawkish side, and we'll play our role as expected. So let's also give this a bit more room. Basically, the expansive monetary policy is still appropriate. This is what we really say. I mean, it's not that the Bundesbank wants to have it changed everything from today to tomorrow. We still think that it's appropriate. But the extent and the taking measures can maybe be changed. And sure, we also make sure that the market knows that we think that the monetary policy will remain expansive even after the end of the asset purchase programs due to the reinvestments, and they are massive next year. But the pace of the monetary policy expansion might be slower. However, the reason why we really want to have the change to come and make it clearer is that we say the purchases, especially of the public sector securities, remains an area of concern for us, as the boundaries between monetary and fiscal policy seem to be weakened. Sure, and I know it's global interdependence, but you know that we are always happy about our independence, especially in the Bundesbank in Europe. We know there's lots of interdependence globally, but also with other policies. But nevertheless, we need to keep a keen eye on what's going on. And anyway, so far so good, I would say, with the results end of October. And indeed, it's the first step to exit the unconventional policy. And we think it's a good first step and look forward to what's going to happen next year. Thank you so much.
Thank you. Thank you, Frau Moede. I heard her stories and found many similarities between the two central banking systems, actually. One is about the Phillips curve, whether it's dead or still there. The second is the process of normalization should look like something like, as President Harker's words, perhaps what he said, gradual, predictable, and boring. I have a number of questions to these points, but before asking my questions to central bankers, let me ask Yoshi to make your initial remarks.
Good morning. It's a pleasure to be here this morning. I would like to thank the Global Interdependence Center and Asset Manage One, especially Koide-san, for giving me the opportunity today. The only problem is the title of this session, how to cope with unconventional policy. This word cope, my understanding is it has sort of a negative feeling to this, but from the central bank perspective, we're doing this to support sustained growth as well as to have stable inflation. So probably another word might have been better, perhaps. What I'm going to try to do this morning is three things. Talk a little about recent evolution of monetary policy, Second, the different phases of monetary accommodation among central banks and advanced economies. Here you will have to cope with me in that sense because I'm doing the reckless challenge of talking about not just our monetary policy, but also monetary policy about the US and the Euro area in front of President Harker and from Moede. And finally, a little bit about our current BOJ monetary policy. I'm sure everybody here in this room knows these things, but just to sort of refresh your memory. Yes. Conventional monetary policy, of course, is influencing short-term interest rates, in principle above zero. And now we have what? Unconventional monetary policy. Asset purchase on the quantitative side, mostly purchases of usually government bonds. But of course, we also have what we understand as qualitative easing purchases of, for example, corporate bonds, other types of assets. You could also put that in the quantitative side. It probably depends from central bank to central bank there. And of course, we have, a lot has already been spoken about, forward guidance. This is also quite important. Perhaps some of this might become conventional in the future. Who knows? When we talk about conventional 10 years from now, we might have a different paradigm. And of course, short-term interest rates below zero, the negative interest rates, that certainly is another sensitive, debatable topic, different from country to country. And what waits ahead in the future? Just recently, former Chairman Bernanke, he talked about temporary price level targeting, to sort of deal with this zero lower bound constraint. When you don't have enough room, you why not the central bank commit to a certain price level for a certain period of time so that to push up inflation and to stabilize inflation expectations. Perhaps this might be something in the future for us to think about. And of course, Professors Blanchard, Mr. Summers have talked about the importance of increasing policy space, especially during good times like what we have right now. And in that sense, there is some discussion about not 2%, but even higher inflation targets. Certainly from a central bank perspective, right now it's a bit uncomfortable, but certainly there is some debate there, or to even introduce nominal GDP targeting. So that is some of the sort of discussions right now in the academia. Moving on to the second point of my discussion about the different phases. A lot has already been spoken, but just to sort of once again compare where the advanced central banks are at this moment. I've looked at sort of policy rates, the asset purchase policy program, quantitative easing, and just forward guidance for four central banks here. As you already know, the Fed is ahead in this area, has already raised interest rates 4 times, perhaps we might have a 5th during the course of this year. The ECB and the BOJ are basically unchanged at this moment. The Bank of England, in a different way, raised interest rates earlier this month, but probably to sort of take away some of the accommodation considering their higher inflation rates. On the asset purchase side, already the Fed has started to decrease its size of its balance sheets. The ECB has started to reduce or announced its sort of reduction also from earlier next year on the monthly purchases. And the BOJ is in a slightly different framework in the sense, certainly we are continuing our asset purchases, but our goal right now is to control the yield curve in 2 points. So our purchases are to make sure that it is sufficient to maintain this control. And of course, the BOE has completed its asset purchases, and I guess we'll have to wait and see how they deal with decreasing or normalizing their balance sheet as well. Here, I won't go into detail about forward guidance, just that a lot of our forward guidance is in the same direction in the sense that we are committed to maintain sort of accommodation for quite a long time, as long as sort of the overall economic and inflation conditions do not change. Then why are we at sort of these different phases of monetary accommodation? Oops. Yes. Ms. Moede has talked about sort of our interest rates. This is sort of the inflation rate comparison of the 4 areas. the Bank of England, certainly with inflation at 3%, is starting to sort of take away the accommodation. The US and the euro area, quite envious from our perspective, was still below their targets, but around 1.5%. In our case, our CPI is slightly above zero, around 0.5%, in that range at this moment. Then why do we have these differences? This is just our sort of analysis within our department. I forgot to give my disclaimer, but this is sort of our view, certainly not the policy board's view, but just trying to understand why we are at different phases. President Harker already spoke about this timing issue, that the US is already ahead. We're sort of delayed in that sense, but why do we have that difference? We're trying to understand this difference. And what we did here is a fairly simple exercise of looking at individual price movements, and this is a histogram, and we've compared it before and after the global financial crisis. Before the global financial crisis in 2006, when the PCE core for the US was around 2.4% overall. This is sort of the distribution of the individual items. You will see it's a nice distribution, roughly the median around, or the mode around 3-4%. And after the shock, then the inflation rate fell to 1%. And then naturally this sort of curve shifted. But still you would see sort of the median around 2. And after the crisis, in 2012, when the economy recovered, prices started to rise, it's around 2.1%. You see this shift back to around 3%. This is what happened after the crisis. More recently, we've seen this very large change in the oil prices. Certainly that also has not just a direct but indirect effect on prices as well. You see, once again, looking at from the 2012 peak for the US, overall inflation has gone down to 1.3%. You see this shift, but now there's sort of 2 bumps here. But still, the main bump is around 2%. And now inflation is around 1.5%, and our interpretation, I'm going to be careful, it's our interpretation is that one of the concerns, or a lot of the debate within the FOMC when we read the minutes around sort of where is inflation, perhaps one reason is that in the inflation, sort of the mode hasn't really shifted back completely. It's now around 2%. Although inflation has risen slightly, we're still seeing the similar types of bumps here. Perhaps that's one factor that's a part of the discussions at the FOMC. Now, how about the euro area? Similar types of situation, but I'll be a bit quicker here. Before the GFC, around 2% bump. You see it go down to the left-hand corner slightly as inflation went down to 0.9%. Inflation came back up to 2%, slightly shift back, but the mode here is 2%. What's happened during the more recent oil price shocks? From 2%, now the mode is around 1. Inflation has come back to 1.2%, but the mode is around, rather than 2, it's still around 1. So perhaps this is, once again, our understanding of the debate within the ECB's governing council about the concerns about where's inflation in the euro area as a whole. Perhaps because inflation, although it is anchored, but it is anchored slightly below what they had hoped for or had seen in the past. Perhaps those are some of the discussions that they're having. But still, this is, from a central bank perspective, much better than the situation we are seeing. Unfortunately, because of data constraints, I couldn't do a similar exercise for the Japanese economy, but this is from our sort of semi-annual economic forecast. This is an April 2016 version, but you see in the early 1990s, we had this nice shape here. The mode was at 2.2%. And then it is shifted this way. And before the introduction of QQE, it was around minus 0.3%. in the early parts of 2016, it shifted upwards here, but probably we're somewhere around this zero area. So that is why we are having these concerns about sort of anchoring inflation expectations. It's, in a sense, anchored as a position lower than where we want it to be. And naturally, that is why the Bank of Japan is continuing its current QQE with the yield curve control. Finally, just about monetary policy in our country. At the end of October, we just announced, or our policy board announced its views on the forecast for real GDP for the next 3 fiscal years, as well as for CPE excluding fresh food. Currently, our estimations for our potential growth rate is slightly below 1%. So you will see for fiscal 2017, fiscal 2018, growth above potential. That will certainly have a positive effect on the economy, more pressure on wages. Inflation pressures should be gradually rising. That's why we're expecting, although 0.8% this year, 1.4% for fiscal 2018. And in fiscal 2019, as sort of the business cycle matures, we will certainly see some slowdown, more close to potential. Also, the effects of sort of the stimulus activity that we're seeing in preparations for the 2020 Tokyo Olympics will start to fade. So we're expecting growth around 0.7%. But since our output gap is already in positive territory and we're growing beyond potential during these phases, inflation, in our view, should be reaching around 1.8%. This is showing just what I showed you in graphs. The point, this is sort of our version of the dot chart. So the individual members of our board give their sort of dots. And the point is that if it's round, it's sort of stable, and depending on which way the arrow is showing, it shows whether the risks are skewed to the upside or to the downside. So this shows our board members are fairly confident about where the economy is heading at this moment, but certainly there are concerns, especially on the downside with regard to prices, especially up to 2019, whether we'll be able to reach that 1.8%. Although the median is there, you can see a lot of the arrows pointing in that direction, in the downward direction. So within this current condition, a lot of you around the table or sitting here already know we will maintain our yield curve control until sort of reach our price stability target of 2%. Of course, also taking into account developments in economic activity, prices, as well as financial conditions. We are targeting pinpointing 2 points of the yield curve to maintain this shape here. We also have a inflation overshooting commitment in the sense that we will continue our expanding the monetary base until the year-on-year increase in the observed CPI exceeds 2%. This is important. We want CPI to once go above 2% for some period so that it can stabilize in the future at 2%. I will stop here. Thank you very much.
Thank you, Mr. Nakata, for your excellent discussion of not just the Bank of Japan, but also the ECB and the Federal Reserve, which was a really nice summary of the 3 central banks' strategies, actually. We have almost half an hour for the discussion among us, but taking advantage of the status of moderator, let me ask 3 panelists only one question. As I said, or as President Harker said, normalization should be conducted in a gradual, predictable, or boring manner. And Frau Moede says that, he quoted here Weidmann's remarks, if anything happens, it will be a small step, not a big bang. and Yoshi Nakata emphasized the importance of communications policy. I understand those central bankers are very careful, wary, not to surprise the market, because normalization of this size of monetary ease is unprecedented. Although the BOJ did once in 2006, but it was normalization from, say, 30 trillion yen to 7 trillion yen. But nowadays it's 10 times bigger than that. So, and also we all experienced a so-called taper tantrum in summer 2013, if I remember correctly. That, small remarks of Chairman Bernanke really surprised the market. So I fully understand how careful you want to be in this game, but at the same time, I remember May 2014, when the Fed used the word measured pace increase of interest rates. And it was done 10, 12 times the same way. And the market developments were so predictable to the market. Monetary conditions continued to be easy despite rather nice increases in interest rates. And I also remember vividly one central banker said in those days that as long as music is on, you've got to get up and keep on dancing. And actually, banking system continued to funnel money into subprime loans and other risky financial businesses. The upshot was actually the fiasco we saw in 2007, 2008. So my question is there any risk at this time to, let the financial excesses be accumulated in the system, partly because of this careful monetary policy communications policy? Related question is, if inflation unexpectedly accelerates, okay, that will definitely have an impact on U.S. treasuries, bonds, and JGBs. If that happened, what the central bank could do or should do. So this is a set of questions, if I may pose to the distinguished panelists. President Harker?
So let me answer the last question first. I think if we saw an acceleration of inflation, we know how to handle that. I mean, of all the tools in our toolkit, that's the one that we have the most experience with. So we would act accordingly. Again, probably with somewhat of an overshoot of our 2% target. Our target was always meant to be symmetric. That is, it's not a ceiling, so that we would be okay with overshooting it. But I appreciate the word you use. It's not about the level of inflation as much as the pace of change, right? The rate of change of inflation. So if it is accelerating and increasing in terms of the acceleration, then we behave differently compared to if it was just creeping up to a 2% goal. So I think in that case, I feel very comfortable that we have the tools in our toolkit to be able to handle that. So I don't know if others want to talk about that question first, and maybe we can go to your first.
Okay. From Moede?
Well, yeah, I could fully agree. If the inflation is really accelerating, we know what to do. We have experiences with this, and we are not getting nervous if it's kind of overshooting the target. I mean, you might remember that the Bundesbank has kind of said, yeah, you're always kind of a success story, but if you really look at the figures, we not always were quite at the target, and we never got nervous with this. You always have a long-term view, and especially if there's kind of unexpectedly accelerations, we shouldn't behave too nervous, because usually the markets are nervous enough. So we will probably not communicate as boring as now. Might be also some surprises, or kind of make sure that the market understands that's a different story now is going on. But I would agree, we know what to do then. Yeah.
Well, Mr. Nakata, perhaps it's too premature to ask you this question, but the first part of my question is about financial excesses. Perhaps President Harker and Moede would respond to the first part of my question later, but you could cover both issues.
Okay. First of all, on your second question about what happens if inflation unexpectedly starts, the pace of inflation starts rising in the U.S., I believe we're confident that the Fed will steer the U.S. economy and the U.S. financial markets in the correct way, or in a positive way, so that the global spillovers in itself will be quite minimal. From our perspective, my understanding is that the inflation expectations or influences in the U.S. and perhaps its influences on interest rates in the U.S. will not have a direct linkage to what the BOJ does, but certainly as the implications for the global economy start to emerge, certainly that will be something that our policy board will take into consideration in how it deals with monetary policy as well as its communication. On your first point about financial risks, at the BOJ, certainly we have a two-pillar framework. We look at the first pillar, looking at the Japanese economy, the state of conditions of inflation, prices, and then with the second pillar, we look at financial conditions as well as financial stability issues there, and the policy board will take those types of situations into consideration in making its judgment on monetary policy.
Thank you. From Moede, I was in Frankfurt last week, actually, and my taxi driver complained a hell of a lot of the rises in real estate prices, property prices in Frankfurt. So about the financial excesses, you're not so much concerned about my taxi driver then?
Well, but the taxi driver, actually, yes, he might be true. The prices for flats and houses are rising, but that's not just because of the economic situation in general, but the specific problem we have with Brexit. So we're expecting more people to move from London to Frankfurt, and so, yeah, I'm glad when I'm returning to Frankfurt that I have a flat in Frankfurt. Yeah, so indeed, yeah, this is also a specific problem in Frankfurt, but nevertheless, in Germany you can see rising housing prices, but still not judging this to be a bubble, because financing of the houses is still sound and safe, the background behind this. But on the other hand, yes, the Bundesbank always, and nowadays all the European central banks are making sure that they have not just their task in looking on monetary policy issues, but financial stability as well. It's the most important topic since the financial crisis. We are looking at, well, interdependent. It was all the other central banks meeting in Basel and having this on the top of the agenda. And we definitely, Bundesbank thinks we may have to make sure that the prices, again, are functioning in our markets, and we stop from kind of having too much interference from central banks or the state on prices in general.
Thank you, Moede. President Harker, I know macroprudential policy is there to be geared toward financial stability. But as I said, 2004, 2005, 2006 period, Federal Reserve System issued supervisory letter warning against subprime lending twice or three times.
Right.
But as the commercial banker said, as long as music was on, they kept on dancing. Do you think that macroprudential policy will work well? And well, before that, perhaps you have your view about about financial excesses, if they are there or not there?
So I'm going to answer the question all at once. So obviously the Fed, our mandate from the U.S. Congress is price stability and employment. But we do also have a charge as the regulator on financial stability, and we have those macro-prudential tools. So I do think that while when the music's playing, you keep dancing earlier, then more people are sitting down now, taking a rest than they used to. They're getting older, I don't know what it is, but we have seen in recent history, for example, there was a concern that was raised, and we talk about financial stability every meeting of the FOMC. We have a briefing, or every other meeting, on financial stability issues. So it is something that we keep close attention to. There were issues a while ago that concerned commercial real estate, particularly multifamily housing units. There was some guidance that came through to financial institutions, and they did what was appropriate and pulled back. That is, we have certain ratios that we hold, but not firmly. That is, if an institution can convince the regulators, us or the OCC or the FDIC, that they have the tools in place, the expertise in place, the processes in place to exceed those ratios, we're not going to stop them because if they have a strong track record. But where we're concerned that some institutions were taking risk that they didn't quite understand, and they pulled back appropriately. More recently, we have seen through the system on the consumer side, some institutions pulling back on subprime auto and credit card lending. And again, this is exactly what we want to see. That is, the institutions themselves recognizing, sometimes with input from the regulators, that this is a risk that you have to really understand more deeply. So right now, the behavior we're seeing from the institutions, I think, is encouraging. That said, it doesn't mean we take our eye off of watching these institutions to make sure they're taking prudent risks that they understand. And so far, I think I can only speak for myself, confident that the macroprudential tools to date have functioned well, but we have to continue to monitor that.
Thank you very much. Now, let us open the discussion for the floor. Anyone? Takita-san?
Thank you, Horii-san, and thank you for the very excellent panelists. Thank you. My name is Yoichi Takita from Nikkei newspaper. I am a senior staff writer for Nikkei. That's why please allow me a little bit broad question to you, especially to Mr. Harker. So,
look at the rude question.
Sorry. Anyhow, I'd like to raise concerning about the concept of the monetary policy. Mr. Harker, you said that the gradual and predictable and somewhat boring exit policy in the United States. Perhaps it may be true in the ECB, but I'd like to concentrate in the U.S. case. We know that Janet Yellen, the Fed chair, will retire next February, and Mr. Powell will come to the chair of the Fed chair. Then my question is very simple and broad. Is there any chance of the change of such a monetary policy concept, especially in course of the exit process of the Federal Reserve? It's my question to you.
Sure.
Thank you.
Well, thank you for the question. First, just a clarification. So, Madam Chair Yellen will step down at the end of January as chair of the Board of Governors, but she has made no determination. She can continue her service as a governor, and there has been no decision made, to my knowledge, whether she will or will not do that. That's completely in her hands to decide that. So she may stay on. We don't know. In terms of monetary policy, at the Fed, I think one of the things that impresses me, and I've been now 2.5 years in this seat, is that while the governors are very important, and particularly around policy issues outside of monetary policy, that is regulatory policy, et cetera, the Fed the FOMC consists of the governors plus 12 Reserve Bank presidents. And that was a compromise that was reached in 1913 for the Federal Reserve Act of 1914, and it creates a level of stability across the system that I think is very healthy. So while there may be changes to particular governors or presidents, that process of change is rather slow and methodical. And I think that's a good thing, because again, particularly in the environment we're in, where the economy is doing quite well. There's very little slack left. And as I remind people, or as my neighbors remind me at cocktail parties, you obsess about inflation being too low. We're fine with it, right? The rest, we're just completely fine with a 4.1% unemployment and inflation running at 1.5%. What are you worried about? Well, I try to explain we're policy wonks and bankers and we care about this. But so we have to recognize that this is a very strong economy. And so I think the members of the FOMC and of the broader Fed understand that, and that there be no dramatic change. It's just not the way the Fed tends to work. It's just not baked into the way we are structured.
Thank you very much.
Any other questions? No question at the moment? Yes, please, gentlemen, the gray suit. Before that, could you identify yourself?
Oh, yeah. My name is Richard Van Horn, and I'm with Glencoe Asset Management. So I'd like to ask Mrs. Moede about the labor situation in Germany, your unemployment rate, how you handle the statistics. It was a couple of years ago that about 1 million people entered your country, and I wonder what the implications of that movement is, either now for your statistics and keeping track of who's in the labor force and who's not, and then also for the future. You know, how long does it take, and what does this mean for the labor force and productivity and inflation and whatnot in Germany?
Well, yeah, thank you for the question. Okay, yeah, you remember immigration or the influx of refugees into Germany and, well, all of Europe, but especially into Germany, and we were really open on this issue. And yeah, on the one hand, you can't expect all these refugees to be able to work in the German labor market from today on. So it takes a while, and it's quite an investment into the future to train them. They have to learn the language, they have to learn German, they have to learn a trade, because some were helping in areas where you need unskilled laborers, and you could see that it was kind of helping the economy in this area. But if we want to keep them, or if they want to stay, we need them to have skills and need to be trained. And that takes a while. They come from a totally different environment, at least those coming especially from Africa. Very different work culture and ethos. I can tell you from experiences of friends who are kind of local heads of cities or so. And then, yes, you have people coming probably from Syria who are kind of well-trained doctors, so they are more easy to integrate. And then it's not in one way to say, okay, some enter the kind of workforce and you'll find them as unemployed in the statistics, because some stay in a kind of training bunch. So you'll have them still in kind of being in training, like all our students or things. They are not counted as unemployed, if this is helping you. So they are still in training, either at universities or in our training system we have in collaboration between schools and companies. I hope this is answering your question. I don't know.
Thank you. Any other questions? Let me ask you then the last question I have. you have, there's someone else?
Sorry,
I'm sorry.
good morning.
I'm sorry.
Surya Bhattacharya from the Wall Street Journal. 2 questions for Mr. Harker. Might you favor more than 3 rate increases next year, given recent strength in the U.S. economy and labor market? And the second question, what do you think of President Trump nominating Mr. Powell to succeed Yellen? Sorry, quite direct.
So I can, let me talk to the latter first. I mean, I've worked now closely with Governor Powell for 2.5 years, and I respect his insight into the markets and into the economy, and I'm looking forward to working with him in the years ahead. I also really respect and admire Madam Chair Yellen's work. I think you look back, and history looks back, on the history of the Federal Reserve System and the U.S. economy, it will look quite favorably on the Fed that Madam Chair Yellen led. So with that, I have penciled in for this year 1 rate increase and 3 for next year. But I say penciled because I want to make sure that we are making progress towards our inflation goal. The inflation issue, as Madam Chair said at a press conference, the last press conference after the FOMC meeting, is a conundrum, as I use the word in my prepared remarks. We don't, honestly, we don't as a profession quite know what's going on. There's lots of different things happening. On one hand, there are pressures of global growth in Europe and Asia, and Japan in particular, that are pushing, you would imagine, global inflation up. On the other hand, we've been saying transitory factors for a long time, right? And you can't keep saying transitory factors year after year after year. And there's evidence, particularly from one of our economists, Leonard Nakamura, who's very well known for his work on mismeasurement of inflation and productivity. And if we're mismeasuring it on the high side. That is, there's been tremendous productivity growth in our economies that we're not capturing. And hence, we're understating productivity growth and we're overstating inflation because of our measurement systems. So if that's true, then we still have a lot of room to go with respect to inflation. So what do you do about that? And I think the comments earlier were brought up about Chairman Bernanke and Professor Summers and others, and there's many possible solutions to that. One is to raise the target from 2 to 3%. Well, my goal, I wouldn't take any of these ideas off the table, but let's first get to 2%. That's one idea. And then we should be studying that right now. Second is price level targeting, as former Chairman Bernanke said. Again, that is an idea worthy of consideration. However, let's start getting prices moving, and we can talk about that in terms of implementation once we're far enough away from the zero lower bound. Again, no. But the third issue, which nobody has mentioned, is we have in the U.S. and globally a very low neutral real rate. All right, and that it may be causing lots of issues around inflation. Not to get a little wonky, but if there's a reasonable probability that we'd hit the zero lower bound on a regular basis, then the average of inflation by hitting that lower bound will tend to run under 2% no matter what we do. That is the non-ergodic distribution, and there are issues around that. So other ideas that people have come up with is, instead of a target range. And that idea has been floated. Again, worthy of consideration, although there are some technical issues there in terms of our modeling and the non-uniqueness of equilibrium in those models. But moreover, there's some appeal to it too. The rate that we control the most, the Fed funds rate, we have a target. The rate we control the least, inflation, we have a number. And so there is some validity in terms of communicating to the public about a range. But again, these issues need further study. And the last that people have proposed is just a asymmetric loss function. That is, we don't think of misses on the high and the low side as equal loss. And again, not all that is an active debate within the economic profession and throughout the Fed. I would say right now I'm an open mind to all those, but for now, we need to just continue to try to move toward that 2% target. And if we start to see the underlying data, wages in particular, start to move up to 2%, then I feel more confident in 3 increases for next year, back to your question. But if I don't see that, and I continue to see stagnation below 2%, then I think we might be in a wait-and-see attitude. at least for me.
Very interesting. Any other questions? All right, just time is being up, perhaps.
One more back here.
Oh, you have, the last question then.
Yes, thank you. My name is Mako Kotani from Broadcast Satellite Japan, which is a Nikkei group. And my question is to Mr. Harker, as well as to Mr. Nakata. And I think there's a common issue between U.S. As well as Europe and Japan, whereas CPIs would not raise, and it's really hard to create the conditions of inflation, as you've mentioned. And my question is that, is it more of an industrial structural foundation that has the fundamental problem?
Okay. In the Japanese case, as you know, we've had sort of this deflationary type of environment for over 20 years, and that for both households and for firms, this sort of very cautious approach toward spending or to invest for the future has been consistent. And that has sort of influenced sort of the adaptive sort of approach toward inflation expectations. And I guess the only way forward, it's probably both a macro cyclical and a structural, but I think we have to be very patient and work to improve our productivity and our growth potential, and then we will see more positive signs there. Thank you.
So in the U.S. context, again, a lot of competing theories about this. Wages, for example, there was tremendous damage, scars left from the Great Recession. So a lot of people have not demanded higher wages, but other benefits like more guaranteed employment, other non-pecuniary benefits like time off or more flexible work environment. So that's all run its course, and we're starting to see some wage pressure starting to build up, which eventually should translate into higher inflation. That said, and we're starting to see some of that. If you actually look, some of our colleagues in San Francisco plus our staff in Philadelphia have looked at wages, but not on average, but look at the compositional shift. As baby boomers retire, that demographic retires in the United States, higher priced labor and being replaced by lower priced millennial, on average, they're keeping the average the same. But if you look at people who are in the same job for a while, their wages are increasing far ahead of what you would say the average is. So we may be, the averages hide a lot. Averages in general, right, hide a lot. And in this particular case, average wage increase or employment cost increases may be hiding some things. Again, there's further study needed on that. So there are a lot of factors that may have held inflation down for a while. The other, in the U.S. context, and there's been evidence on this too, is with the Affordable Care Act and the flattening out of healthcare costs for a period of time, which is, of course, the dominant part of our economy, that has bent that cost curve for a while, maybe not forever, but that's held down some healthcare costs. I can't imagine that that will continue forever. I just think given the history of healthcare inflation, that will start to come back in a more significant way. So I think there are pressures now that are building that would argue that inflation should be increasing. But again, I'm a pragmatist, and I want to make sure I see that before we act, or at least see signs of it, and make sure we don't get behind the curve. But I see no evidence right now that we'd get behind the curve. That is, if inflation's moving, it's not moving rapidly. And so we have time on our hands. We have time on our side.
Well, thank you very much for all the discussions of the best quality, in my view. And let us wind up this session by giving a big hand to the great panelists. Thank you very much.
Well done.